For more on what's ahead for the Fed, let's bring in Claudia Sahm. She's the chief economist at New Century Advisors and a former economist at the Fed. Let's start there on productivity. Do you have any expectations for productivity and its impact on the economy right now?
Right. Well, I just want to underscore what Steve said. Having productivity boom that we've had recently, this is the best kind of problem the Fed could have to deal with. Right. Because this is, very good for the economy, grows the pie faster. The difficulty for the Fed is trying to figure out of the growth we've had, and we have been living through this. The past 2 years, we have had well above trend growth. And the Fed has had to try to navigate how to get inflation down. At the same time, we've seen disinflation. So a lot of that above trend growth we've had, that was this supply, that was this productivity. We also have had more workers come online. So the Fed does not need to fight that kind of growth. The Fed fights when demand-driven growth gets out ahead of supply and they need to slow things down. But of course, you can't look at a GDP number and have it tell you this is a demand part, this is a supply part. And it's very important because monetary policy takes time to work its way through the system, is how persistent do we think things are? And frankly, at this point, and when you look at the Fed's projections, when you listen to them talk, most of them are taking a pretty cautious view of the productivity path going forward. And we really haven't seen a lot of officials taking on and saying, hey, it's here to stay, this productivity boom, we're going to build on it. So they don't have that optimism built in their forecast. But I think that's something they're going to obviously continue to watch.
Well, is part of it, too, just understanding exactly what's causing the productivity boom, to understand its resilience and the implications for monetary policy, really kind of getting to the root of what's driving these buoyant numbers that we've seen?
Right, absolutely. And really, this productivity boom, the seeds of it appear to have been planted soon after the pandemic. And in all of the disruptions that were happening, we saw a burst of business applications, and which has held up over time, which researchers have carefully traced through other databases to see it's not just the applications, it's businesses starting with employers. And we know that younger, more dynamic firms tend to get the productivity going. So that's been important. It took, years to play that out. And then the other thing the United States has really stood out in this cycle since the pandemic is we have had a really dynamic labor market in that we moved a lot of workers to better and different jobs than they were before the pandemic. That was very disruptive. We can remember the labor shortages and how that was tough on businesses and on some workers. But that really put people, matched workers up with jobs where they were more productive than before. And it gave businesses a big incentive to make some more capital investments to make the workers they had more productive. And so we're reaping the benefits of that now. But then the question is, can we hand the baton off to emergent technologies and further capital investments? And that's where there's a big question mark. And technically, history is on the side of the productivity growth returning back down at a more normal, lower pace.
So, hey, Claudia, I want to come full circle. What does this all mean for the Fed long term? I mean, coming up on January 10th, we get the jobs report. But before that, on the 8th, we get those Fed minutes. What are we expecting, or what are you expecting to hear from these Fed officials about productivity, about the incoming administration? I feel like Jay Powell said, Fed members at least acknowledge that some of these policies might take place and the impact that would have on the labor market, on inflation, and other parts of the economy.
Where I can see it showing up in some of the Fed discussions this year are around what the neutral rate of interest is. Right. And it's a structural parameter in the economy that gets saving and investment in alignment. Productivity, potential output growth, these are integral. These are considered to be things that would tie in. Like if the economy is just more productive, it's growing faster, but growing faster in a very sustainable way. Well, interest rates should be higher. That's a sign of a healthier economy. The Fed funds rate should be higher. That's what that you're not fighting inflation. You've just got a healthy economy with higher rates. So, but the thing the Fed officials haven't done thus far is, though they have been nudging up their neutral rate of interest estimates, their R-star estimates, we haven't really gotten a lot of dialogue on why. And they haven't moved their potential output estimates, which would typically be, the median official hasn't moved them, which would typically be where that is. And Jay Powell has been pretty allergic to going through in careful detail, parsing out the neutral rate of interest. So I think they're going to have this conversation. And yes, I think the minutes are one place to be looking for this and definitely listening. Anytime to get a Fed official like, hey, you raised your neutral rate. Why? What's going on? What changed? See if it's productivity.